Well, I believe that equities still show value today. We need to be conscious that the markets have been moving up since March, and therefore there's a split perception between sectors with the sectors like technology, health, that are still valued even though PEs are high, and the value sectors or the traditional sectors that are still lagging, which I think is really what's happening in the market. So we are still constructive on the equity market, even though PEs are 19 times, 19 in Europe, 22 in average in the US. But obviously, we believe that the recent package that we've seen in Europe for stimulus is bringing some value, and also is going to help the European market to probably catch up with the US market at the moment.
Yeah, that $2 trillion package, 1.8 trillion euros, helping out the euro. Do you think it was a game changer for the currency, perhaps?
What is probably a game changing for the currency is also the interest rate differential. The interest rate differential between the US and Europe used to be in favor of the dollar. What I'm seeing today is probably something where the euro should be catching up.
Nicolas, it's Dan here. As we come into the August-September trading period, is there a catalyst that's going to move these markets higher? What's your outlook?
The outlook, again, is that the markets are no longer looking at 2020. They're already looking at 2021 or 2022, and they're looking at the potential for the different economies to rebound. I think that that's really what's driving the market. At the moment, we know that we're going to have mixed news. We know that, as an example, we will have additional news on bankruptcies going up in some sectors across the globe. But we know also that there might be a second wave of the COVID-19 in different countries. So my belief is that the public market investors are at the moment looking already at the rebound and probably at the U-shape recovery. And that is what is going to be driving the market across the year. At the end of the year is one, perception about the rebound, and second is perception about the COVID-19 second wave.
I wanted to ask you about the outlook for China as well, because while it seems like, at least in the United States and perhaps some markets in Europe, we're seeing equities decoupling from their economic reality of the underlying economy there. But over in China, the activity's been really interesting because we've seen China avoiding that recession in Q2, mainland Chinese equities, of course, surging throughout the course of July. Yes, we've seen a modest pullback in recent trading sessions, but is the Chinese equity market, particularly the mainland market, something you want to be exposed to right now, or are you avoiding this?
Actually, I think that we want to be exposed to markets that are going to be resilient and that are responding well to the current crisis. The mainland Chinese market is probably one of the markets that we would look at. And you're right, by the way, that a lot of our clients and a lot of the investors are trying to find a reason why public markets look so disconnected from the real economy. They don't understand that Apple, as an example, in the US employs only 80,000 people in the US, but is number one on the cap size and number one cap on the S&P 500, whereas Walmart, which employs 1.5 million Americans in the US, is only number 40 in the S&P 500. So they see a disconnect in this market, and that's why also we're seeing more and more demand for private equity or private assets, because it looks like private assets have more connection with the real economy than stocks.